Hi everyone and welcome. It's Steve Johnson here, Chief Investment Officer at Forager Funds, and you're tuned into our March quarter webinar. Got a really good turn up today to the webinar, so it must be something happening in the world to keep people interested. Before we kick things off, today's presentation is general advice only. We do not take into account your personal circumstances, so please seek advice where necessary. I'm joined for today's webinar by Gareth Brown, Portfolio Manager on our International Shares Fund, and Alex Shevelev, Portfolio Manager on the Australian Fund. Hi, gents. How are you?
Hello, everyone.
Hi, Steve. Hi, everyone.
Thanks for joining us today. I'll give a short introduction and an update. We're actually going to do things a little bit differently today. It's been such a crazy last couple of weeks that we are going to talk a little bit about what's happened in the past couple of weeks, as well as what happened to the end of March. And we've been putting a lot of work into preparing for an environment like this. So looking forward to sharing what some of that preparation looks like for you. This is the quarterly results to the end of March. The international fund was down about 3%. The Australian shares fund down about 1% for the quarter. Alex and Gareth will give you a lot more details about what's been driving that performance, but you can see most importantly on this slide here that those longer term numbers are looking much healthier after a couple of years of really good performance. And like I touched on, we've spent a lot of the past 6 to 12 months in particular preparing these funds for more difficult times. We were not happy at all with the amount of performance that we gave back in 2022. And part of what we've been doing over the past year is being willing to tolerate a bit of underperformance in up markets to better prepare ourselves for down markets. And what does that look like? Well, first, making sure we own businesses that are going to be worth more in 5 years' time than they are worth today. And that's particularly important that we're very diligent around companies where the share price has run up a lot. Some of our best investments we want to hold on to for really long periods of time. Some of the things that have done well for us over the past 12 months, we still think have excellent long-term returns ahead of them. But it is important to constantly be asking that question, and we have taken profits on some of our investments that have done very well for us over the past year. Gareth's going to talk a lot about this, but purely on valuation grounds, we have shifted a fair bit of money out of the US in our international fund over the past 6 months. That caused some underperformance since the election of Trump in November, or in the early part of that anyway. It has been very beneficial more recently, and both funds have been holding healthy levels of cash. It gives us some downside protection, but more importantly also gives us ammunition to put to work as bargains come our way in more difficult markets like this. So I've been really looking forward to some more difficult times. I think I have wanted to show investors that we've made some significant improvements here. And that really goes back to those 2018 and 19 years in the Australian Shares Fund. We made some pretty significant changes to our process there. 2022 was a bit of a step back there. And I've been looking forward to some more difficult market environments for us to show you that we really have made those improvements. We run small portfolios that are fairly concentrated, often invested in small cap stocks. This is not a promise that there's not going to be volatility in our returns, but it is a promise that we've put a lot of work into preparing the portfolios for more difficult markets, and that those businesses that we own are well positioned to come through difficult economic environments and also market environments and perform well. So just taking things beyond the end of March here, particularly on the international side, I think there's some really good evidence that setting that portfolio up for these difficult environments has done well for us. You can see on this chart, the US markets have performed significantly worse than other markets around the world. So since the start of the calendar year up until last Friday, the 11th of April, so the NASDAQ, despite a fairly meaningful recovery, is still down 11% for the calendar year. The S&P 500 down almost 9% for the calendar year. Now, both of those are worse than the All Country World Index, which is down 6.4. Obviously, those US markets are a huge part of that index, so it shows you that other parts of the world, particularly Europe, Japan's been quite good for us, have been doing relatively well, and our portfolio positioning there has helped us. You can see our international shares fund. We've put all of this in US dollars here. Just what you're seeing on the news is those US markets in US dollars. So we've just converted our returns into US dollars as well. Doesn't actually make much difference. The currency is roughly the same as it was at the start of the year, but just for consistency there, you can see that in US dollars, that international shares fund is actually up a tiny little bit this calendar year, and that outperformance of our benchmark is something like 7%, and relative to those US benchmarks is more than 10 in the case of the Nasdaq, and very significant in terms of the S&P 500 as well. Gareth will touch on this later. There's one stock in there that is a huge contributor to that outperformance, but even stripping that out, I think the portfolio positioning here has set us up very well. And Alex will take you through some of the Aussie fund portfolio. This is exactly the same slide for the Aussie fund. You can see here that we're actually a touch worse than the market calendar year to date. I think in the context of a fund that has outperformed by 20% over the past year, we're actually relatively happy with that, and particularly happy with some of the businesses that we own here. Again, Alex will give you more detail, but they're businesses that we want to add to if the share price comes down. And across a lot of them, they're businesses where we took a fair bit of money off the table in the rally of the past 6 months, and this downturn has enabled us to add back to some of the businesses that we really like. So look, again, no promises for small and concentrated small cap portfolios, but some evidence here that this positioning and then the lessons that we took from 2022 are serving us well into what has been a much more difficult market so far this year. We're not really changing that conservative positioning at the moment. Obviously, there is a huge amount of noise about what tariffs the Trump administration is actually going to put in place. How long they last is very much an unknown question. I think it's pretty clear, though, that the uncertainty that it has created is going to have an impact on the real economy. And I think that's true even if all of those tariffs got reversed tomorrow. You can see on this slide here, this is Michigan consumer sentiment, a barometer of consumer sentiment in the US. It has plummeted over the past couple of months. It was falling prior to the most recent announcements, but it's now back down to levels that we haven't seen since the depths of the COVID crisis in 2022. So consumers are very worried, and when consumers get worried, they stop spending money, and that money is a company's revenue, and then that company has to lay off staff. And in a modern economy, confidence is a very important thing. You can see the same sorts of charts in terms of business confidence as well. So people are pausing on CapEx plans, they're pausing on expansion plans, and those expansion plans were another company's revenue. So I think we're going to see a difficult environment for the US economy this year. The US economy is such a big part of the world economy that if it gets particularly messy over there, it's going to have an impact globally. So I'd say we haven't dramatically changed our risk settings here. We still want to own businesses with recurring, reliable revenues for the most part. We've been tweaking. We've put a bit of cash to work over the past few months, but the overall portfolio settings haven't changed dramatically. And we're buying businesses that we think are going to be cheap, even if we go through a recession over the next year or two. I'll come back at the end and talk about a few changes at the product level, but with that, I'll just hand over to Gareth, and he can give you an update on where we're at with the International Shares Fund.
Thanks, Steve. As Steve alluded to, this is going to be slightly different presentation than usual. The point of these webinars normally is to discuss the quarter just ended, which in this case is the quarter to 31 March 2025. Obviously, the world's changed quite dramatically in the past few weeks, and it would be remiss of us to not discuss what's been going on the past few weeks. To address that quarter first, though, bear in mind a lot of the discussions around tariffs and economic slowdowns were well underway before 31 March. I would summarize our performance for the quarter as a pretty decent result in a relatively difficult environment, and then summarizing the financial year to date. So the quarter to 30 September, I think it was a pretty good result. The quarter to 31 December was a tough one for us. The Magnificent Seven stock started rallying again. This is in a kind of environment that we find quite difficult to outperform. And as Steve has touched on, we are very, very, very focused on preserving capital in markets that had started looking quite expensive to us. And then this latest quarter that ended 31 March has been, again, a decent performance, quite a bit more fear returned to the market over that quarter. And then we'll address the last 2 weeks towards the end of this presentation. Just on movements over the past few months in the portfolio, European and UK banks has been a theme in the fund for a couple of years now. We own ING in Europe and we own Lloyds Bank in the UK, but they are very similar themes and they're a bet on a similar theme. We bought these at very, very attractive yields to shareholders, so 14 and 15% type annual returns. And what I'm talking about there is dividend and buyback. And these are very big returns. We didn't rely on anything exceptional coming from the European economy. Rather, we thought that the prices reflected that the economy would get worse and worse, and we thought that was too pessimistic. So in many ways, just being stable would have been a good outcome for us. These have started working very well in the past quarter. And again, I think some of the European money is looking at the US going, well, why would I want to invest here at the moment? And starting to look at their home markets and seeing these big fat yields on banks. And that's worked really well for us. Lloyd's was up 32% in the quarter, ING up 19%. It's worth pointing out that these are investments that we think have a fairly tight range of potential outcomes. So you should expect us to trade aggressively out of them as prices rise. And that was the story for that last quarter. We took money off the table as the stocks went up. We've added some of that back in the past few weeks, but that's a story for another day. Next Tracker was an important investment for us during the quarter. This is a business that provides solar tracking technology. So this is hardware and software that helps solar farms to run more efficiently and optimize energy production. The recent results have been really good, particularly the new order book and the order backlog. And management has increased its long-term expectations for profit margins for the business. In many parts of the world, solar is becoming one of, if not the most competitive form of electricity production. And there are technological tailwinds in place here, of which Nextracker is a part of, that are driving those costs down further. So we think it's well placed. Touching on a third business here, Fiserv. This is a payments business in the US, and one that we refer to, at least internally, as a quality compounder. This is a business that has a spectacular history of compounding earnings. So it has grown underlying earnings per share more than 10% per annum every year going back to, I think, 1986, which is a truly astounding outcome and very, very rarefied air in terms of the ability to compound like that. Clover, which is a business their payment system that you may have seen. So this is a payments product and point of sale system for small and medium-sized customer-facing businesses. So you might have seen them at a pub, a restaurant, cafe, etc. And it's been growing very quickly, and we think underwrites at least a few more years of 10% plus earnings growth for the business. That's been
Just
doing
quickly,
really well.
we've got a lot of payments exposure across both funds, really. The Australian fund's got quite a lot of businesses in that space as well, and they've all been pretty weak as fears around recession and economic growth have increased. The share prices have been weak. What's the thinking here in terms of earnings resilience in a difficult environment?
Yeah, I mean, I think there's definitely a chance that throughput in these systems comes down in a recession. I don't think that's a minus 10% type setup for a business like this. It's probably potentially down a few percent, but we have the structural growth story that we think offsets that. I'm not terribly worried about that in the short term. If we had a global depression, maybe you would say all bets are off. Do you have any different thoughts there?
No, not really. I think it's across both funds. There's been a pretty significant overreaction to.
Great.
Yeah, it's a pretty bad recession if consumer spending's down 4 or 5%, because a lot of what people spend money on is essential. So these businesses, Chev might touch on one of them in the Australian fund later, but they've been pretty badly punished in terms of the market. And my guess is the operational results will prove more resilient than we've seen share prices, that's for sure. And then
Yeah,
Japan
very.
quickly, it's been a bit of a, I guess, a behaving quite independently of what's going on in the US, particularly those tech companies we own there.
Yeah, we own a few Japanese tech companies. Obic Business Consultants is one that I was going to discuss today. You should think of this as the Xero of Japan. So it provides payroll and accounting software chiefly to small and middle-sized businesses. Uh, the share price, and we think rationally, has been a little insulated from this Trump tariff madness, given that they are focused on businesses that are smaller, generally domestic in nature. This business generates very high quality recurring revenues that have been growing something like 15% per annum, and we think that continues. This business also has a very significant pile of cash, so about 30% of the market cap currently sitting in the bank. We think that ultimately more and more of that gets returned to shareholders. There's a big cultural shift underway in Japan, where Japan Inc. is being encouraged to treat shareholders, particularly minority shareholders, better than they have in the past. And adjusting for that cash, this stock trades at a pretty decent discount to global peers, despite the fact that it's got some of the best unit economics in the whole industry and it is growing quite rapidly.
I think when we talk about the Zero of Japan, it's almost worth, given what's happening in that economy, the Zero of 2010 in Japan. This
Yeah,
this
that.
transition towards
Yeah,
software, SaaS software is only just getting started in Japan. There's a nice long runway there.
a very good point.
These
Um,
charts really importantly, 28 Feb here that you've put up, Gareth, and maybe you can talk people through why.
as you're talking about the pie charts, right? Look, I think it's a good time to move on to the past few weeks. There's a lot more fear and panic around, rightfully so. These tariff wars have injected the sort of uncertainty that some investors use as a excuse, I guess, to blindly sell a stock without regard to value. We don't want to downplay the concerns here. Like, this is quite a serious issue, but this is much more our sort of environment and where we think we can add value. And that fourth quarter is shaping up as a really good quarter, as Steve alluded to earlier. I think a small part of that, and one I'd like to touch on now, is coming down to that broader portfolio positioning. So as you can see on this chart, we've over the past 12 months, this chart goes to the end of February 2025. We've significantly reduced the amount of exposure to US stocks. This wasn't, at least at first, it wasn't based on any broad concerns about the US. It was more that wasn't a market we were finding lots of value in. We were finding value elsewhere. We took that opportunity. So we added significantly to our Japanese holdings in particular, a little bit extra in UK and Europe. We also significantly increased the cash weighting. That trend continued through the first part of March there. We were starting to get some really poor economic data out of the US, and yet stock prices hadn't moved. They've touched on the consumer stuff. There was just a lot of CapEx related, investment related metrics that were starting to turn pretty soft. This move, I think, has paid off. Well, it has paid off in the past few weeks as the tariff discussions have become an absolute debacle, and the markets have really started feeling some of that fear, and that's helped that our positioning has been good. But the biggest contributor to the past few weeks' results has been a single stock. It is a small cap that has worked spectacularly well in a very short space of time. Given Steve was the brains behind this investment, I thought it was a logical time to flip the script and start interviewing him on it. Nutex, it's a healthcare business. I'll let Steve describe it. It reported its latest results after the market closed on 31 March. In the ensuing 2 weeks, the stock has risen about 180%. So over two of the most panicky, fearful markets that I've ever been involved in, this stock has nearly tripled, which is a pretty astounding outcome. Steve, maybe you can start by introducing our investors to the business of Nutex, maybe touching on how you found it and I guess what you saw at the time when other people were pricing this for a pretty hopeless outcome.
Yeah, I think some of the youngsters in the business, Gareth, are thinking the old man needs to do something useful every now and then. So it's good to have a contribution in the portfolio. Look, this stock is, I'll give a quick description first. It owns 24 micro hospitals in the US. So these are 20-bed hospitals. They have an emergency department, so they're open 24/7. And generally, they only cater to insured clients, patients in the US. And normally, if you're insured and you've got something that's an elective surgery, or what we call that in Australia, you have to go to a hospital that is in the network of your insurer. If you have an emergency and it's the middle of the night, you'll go to the nearest place you can find and you deal with the insurance after the fact. And these micro hospitals cater only to those people who are out of network effectively, and they're setting them up in areas that they think are underserved by the major hospitals, and they're offering a level of service that is significantly better than what the main hospitals offer. So that was the pitch. And then the company came to market in the middle of COVID. COVID itself was driving inflated revenues at that point in time. And the business, I would say back then, was over earning. They got hit by the slowdown in COVID as that COVID unwound. And then far more importantly, there was a new piece of legislation in the US that is called the No Surprises Act. And to cut a long story short, it meant that the insurance companies, the No Surprises Act was trying to stop this gap between the customer, the patient would go to hospital, the hospital would charge them, let's say, $3,000 for their visit, and then they'd send the bill to the insurance company, and the insurance company would say, well, we're only paying $1,600 for that. And the patient would get this out-of-pocket expense that was very significant. So government passed a piece of legislation to say, well, that can't happen. Insurance company needs to pay the bill here. There was a whole mechanism around exactly what price they would pay, and insurance companies use that legislation as cover to pay, on average, 30% less to companies like Nutex. So now, in a fixed cost business, that was all of their profit that eroded. They went from making nice, healthy profits to not making a cent. The share price was down 99 point something percent when I stumbled across it. It had had two share consolidations. So to stay listed on the NASDAQ, you need a certain minimum share price. Their share price had fallen below that. They had a 15-for-1 consolidation. It fell by a factor of 10 again. They had another 10-for-1 consolidation. So there's 150 times less shares on issue today than there were back in when this company first listed. And literally, it was a bit of an option for us. I thought the share price had fallen that far. There was a real business there. We took a very small initial position in this on the basis that they had already started taking some cost out of the business, try to turn it around. By the time we made our first investment, it had bounced off the lows, but they'd also put out a quarterly result for Q2 of last year that was back to generating a little bit of profit and showing some signs of improvement. We got a Q3 result in November that was even more positive. Again, we substantially upped the weighting on the back of that. And then more recently, they've actually had some, I guess, regulatory outcomes that have been very, very favorable, effectively unwinding that 30% reduction in revenue that I talked about through an arbitration process that's built into the legislation, but takes a very long time to unfold. They have been winning a substantial amount of those arbitration cases. When they win, their revenue is 150 to 200% higher what they're getting awarded than what the insurance company was paying them. So now, I had this business penciled in to make $20 million last year. It ended up making 60 for the year. If you back out some of the write-downs, if that trajectory continues, it'll make 90 million US of profit this year. And for context, at the lows, when we first stumbled across it, the market capitalization was 20 million. And by the time we made our first investment there, it was closer to 50 million US dollars. And it's just made that in profit for 1 year. So the prices run up like crazy, and it's still today trading on about 8 times what we think it's going to make in this coming year. So the pace of the appreciation has been surprisingly quick, but the value of the business here is very clearly substantially higher than it was when we first bought it.
Yeah, and I think maybe there's a couple of areas we can touch on there if you wanted to go further in it. That claims processing, it's giving us confidence around the future earnings of this business, which you've touched on, 90 million next year. That is partly about getting revenues that are more closely aligned with historic experience. There's the I guess the back payments that are owed to it. It's going through significant, it's not court. What's the word I'm after here, Steve?
Arbitration, yeah.
Arbitration that is getting it back payments on past past situations where they've been screwed out of more money from the insurance companies. And then I think that other piece there that you touched on, the positioning here, we bought this stock as a risky play. You've watched it closely. You've put the jigsaw together as the pieces have come in, and it's become a far less risky business than we were able to own a lot more of it when the price was up significantly. Anything to add to that? I think that's
Yeah, we've
probably...
talked a lot about that recently, and I think it's one of the most significant improvements we've made over the past 5 years is just really working hard on getting this portfolio management piece right. It's never going to be perfect, but small initial weightings try and mitigate the risk of things that we get wrong. And if we get evidence that we're right, and if the company itself, de-risks, this business went from a bit of net debt, okay, it's generating cash flow now, it's going to generate substantially more cash flow as this comes in. All of those balance sheet concerns go away. There's still a lot of regulatory risk here. This is not a infrastructure business where we're going to have 10% of the portfolio in it, and we have been taking substantial amounts of money off the table recently, not as quickly as the share price has been going up, so the weighting is still quite high there. But that ability to up the weighting despite a higher price, I think psychologically we often find that difficult as value investors, but it's absolutely the right thing to do sometimes as these situations de-risk. I think as well, just the whole small cap environment, the view that you own small caps, it has to go down in down markets. I do think there is more potential for idiosyncratic outcomes in your portfolio, where if you can find the odd thing that goes right in a difficult market, it can actually make a substantial difference to your returns. And this one stock has been, 5.5% of portfolio performance or something month to date. So it's purely coincidental that all of this has happened in a difficult market, but I think it does show that it doesn't have to be just because we're a small cap portfolio, we're down more than the market in difficult environments. I want us to be trying to construct portfolios that perform better than that.
Very well done, and thanks on behalf of all our investors.
But it's still going to be a really important thing for us to manage this next quarterly result. We want to see the cash come in. Like you said, at the moment, most of this revenue is sitting on the balance sheet as a receivable because they've been awarded these things and they haven't yet been paid by the insurance company. So March quarter, we want to see cash flow and a continuation, I guess, of that win rate. They are estimating a lot of their revenue at the moment on the basis that, well, we won a lot of our cases in Q3. So when we book Q4's revenue, we're assuming we're going to win the same thing. So there's lots more water to flow under the bridge here. And again, on the portfolio management piece, we've got a job to do getting that weighting right. But yeah, it's been a very big winner. And I guess Celsius is probably the only comparable sort of situation. And this one unfolded in an even quicker time than that. All right, thanks, Gareth. With that, we'll jump across to Alex Shevelev, and he can give you an update on where the Aussie fund is at and what's been happening over recent months.
Thanks for that, Steve, and hello again, everybody. So I've got here the slide with a bit more detail on the Australian fund's performance. That 3-month period into March, the sort of latter 6 weeks of that was reasonably difficult, and pleased that we were a little bit better than both of the indices there. The 1-year number is something that we're quite pleased with. So that 20% return, I think it harks back to some of the comments before by Steve and Gareth there around just the idiosyncratic nature of the portfolios that we are trying to put together. So that is a 20% return in the context of an all ordinaries index that was up 2 and a small ordinaries index that was down 1. So we're pleased with that. And in that context, we're pleased even with the follow through into April. We've deployed a little bit of capital during March, a little bit more during April. We're generally happy with where the portfolio is sitting at the moment. Now, that 20%, we've talked a little bit about some of these bigger winners over the last little while, but RPM Global, which is a software business for miners and mining services companies, that business was the largest in the portfolio for some time. It has now been reduced to about a 3% weighting. So we've taken the opportunity to bring that down. The other 2 large contributors there, Bravura, enterprise software for financial services. That business remains a large investment. And the largest current investment in the portfolio is the sports technology business Catapult, and it has also been a significant contributor to the 1-year numbers that you
I think
see.
just really quickly there, Alex, again, back to that portfolio management piece. Both of those stocks that have done really well for us and that we really like, we've still taken some money off the table there over past months because that portfolio weighting had got to levels that we just didn't think reflected the opportunity. And that money off the table has given us the opportunity to be buying them back now that the share prices are down 20 and 25% or were. It's been a bit of a bounce, particularly in Catapult over the last few days. But, it got back down to $3 from $4 a share. And it's not all when we're trimming these positions, it's not saying goodbye to an investment necessarily. It's just getting the right weighting at that point in time and giving ourselves the capacity to add when there's volatile markets like this.
Very true. And just on that 5-year number, we just need a note on that side that was from the very depths and the heart of COVID. So those are very good numbers, but the ones that we're very pleased with on the far right-hand side, 10% absolute returns here, 2% better than the All Ordinaries, and nearly 6% better than the Small Ordinaries index during that since inception period, which stretches all the way back to 2009. Now, one of the key investments here over the last quarter has been Nanosonics. This is a bit of a former market darling. They developed a product called the Trophon, which is for the high-level disinfection of ultrasound probes. Now, this disinfection machine, it needs a consumable, a very specific consumable to work. Nanosonics is the only one that sells that consumable. It sells it at north of 80% gross margin. And that revenue line, alongside servicing its machines, which is also a nice recurring revenue stream, it makes up about 3/4 of the revenue of Nanosonics. So these are very high quality and quite recurring revenue streams. Now, they've done a very good job at developing this product into the US market. In fact, they've penetrated more than 50% of the market there at the moment, but the consumables have continued to grow. So we've seen about a 20% revenue growth on that side of a business over years and years, and that continued into the first half of the financial year as well. Now, with revenue growing faster than costs for that Trophon business, margins have expanded as well. So earnings before interest and tax with the Trophon business was up more than 40%. But what has muddied this picture somewhat is that Nanosonics has spent about $100 million over the last 4 or 5 years developing a product also for the high-level disinfection, but this time of endoscopes. Now, that was more recently about a $30 million annual spend, and it made the overall group result look a lot worse. There had been no revenue against that $30 million spend. So that product has now been developed, it's now been approved, and sales are due to start this calendar year. Now, when we were first starting to look at the business below $3, when we first actually bought stock at about $3, we could actually underpin the investment on the value of just the core Trophon business itself at a high single-digit free cash flow yield for a very high-quality recurring revenue stream. And it's pleasing to see now that also not only has that continued to be the case, in fact, the profit on that side of a business has been somewhat better than we expected. We also have had the more enthusiasm kick in about Chorus and what that could mean for long-term growth rates of Nanosonics. There's not a lot of direct tariff exposure across the business. This is one with a small exposure, however. So the product, the capital equipment itself is manufactured in Australia. It's about 1/4 of the revenue, and it is also quite high gross margin. So when that is sold into the US, see what the tariffs end up being, but at the moment they will incur a tariff. But that tariff is quite small in the overall scheme of Nanosonics and able to be passed on to the end customer, given the dominance that the equipment has.
Alex, you can see on the share price chart there, it's been a big run up post those results coming in February. And it's maybe an example, I guess, of a smaller initial weighting not being beneficial to the portfolio here. You maybe just want to touch on the portfolio management around a piece like this. And I guess that is something that is going to happen here over time as we mitigate the damage of some of the early stage things. There are obviously going to be cases of share prices running up quickly as well.
Yeah, so this was a particularly quick run-up. We did take the opportunity during that run-up to add to our position. So after the half-yearly results, where we saw particularly good numbers on the consumables side, and also then after the subsequent approval of Chorus as well. So we now have a larger position, but we do have some risks, for example, on Chorus approval that have been taken off the table. And I think a bit of a recast view from other investors around just the strength of that core Trophon business. So it remains a reasonably sized position at the moment.
Very good.
Just flipping across to some of the, I guess, news and changes. We spoke a little bit about Catapult already, sports technology. During the month, they had a strategy day, so an investor day, and they laid the path out to revenue, which is, in their case, they call it ACV, contracted recurring revenue, effectively. That contracted recurring revenue, they have plans to increase tenfold. Now, these are big plans over long periods of time, but it was good to see the potential building blocks that we would see come off of that. So the business has not historically pushed price terribly much, and these are very key devices on the wearable side and software on the video side for the individual sports teams, the professional sports teams involved. Very low churn, and so the ability over time to improve pricing. There's more penetration in teams, so that 3,500 teams can continue to rise. And then there's the ongoing penetration here of the video product into the existing base of wearables customers. This is a globally dominant wearables business, and it's making good headway in selling its software into that wearables side of the business. On the shorter term side of things, we saw the guidance reaffirmed, which was very pleasing to see. And then the bit that has gotten, I think, a lot of people excited, and us as well, is that the business is moving to a management EBITDA, which is their preferred measure of profitability, margin of about 30%. Now, we think this will happen over the next couple of years. And the implication of that is that each incremental dollar of revenue is coming through to free cash flow at a very healthy incremental margin, which is great to see.
Not surprising to see a bit of a pullback there, I guess, given how much the stock had run up and the current state of markets. But a business that we really want to keep a significant investment in for a long period of time, while ever the share price remains undervalued relative to what we think it's worth.
And worth saying that as we move through to this 30% management EBITDA margin, we will see very meaningful free cash flow in the next couple of years coming off Catapult. I think that will be the next sort of driver of potential enthusiasm. Now, shifting across to PointsBet, this is a bookmaker, and it was bid for during the month by Tokyo-listed Mixi. Now, this is a Japanese business with lots of cash on the balance sheet, so able to make a transaction, but not an existing business in Australia. Bluebet, which is one of its listed domestic competitors, came out on the same day and said, actually, we've got a bid for the business as well here, and our bid comes with significant synergies because we are already a domestic market operator. Now, the core to PointsBet is this customer base that they have and the technology that they have spent a lot of money on over long periods of time here. There's also a Canadian business, and that business will be valued a bit more or a bit less by various acquirers as well. So that situation's current and still to play out.
I'm hopeful of a higher bid there, Alex, but I'd say the general market environment is not conducive to takeover offers. But yeah, there's a lot of we think the bid from Mixi is solid, and I think it's a good thing to get the process started. They're probably not the most logical buyer of the business, I'd say. So we'll see what happens there over the coming weeks and months. And I think there's very little downside from today's share price, other than there is some shareholder crossover between PointsBet and Bluebet, and some PointsBet shareholders have said they would prefer the merger here to the deal that's on the table. So there is a risk that PointsBet shareholders don't vote for this, but we think the setup is relatively little downside and fairly meaningful upside if some potential other bidders come along.
Just moving on to the Tyro side of it. So Tyro is a payments processor. You would have seen their terminals at local cafes or shops. They've actually made a bid themselves for a competing terminal provider, SmartPay. Now, SmartPay is an interesting business. It's had its Australian segment overshadowed by regulatory attention. So the RBA and the government have both looked very closely at surcharging. That surcharging is the core of SmartPay's client base in Australia. However, they do have a New Zealand business, which had historically operated on a terminal rental model, but that is quickly shifting around into an acquiring model. And that has quite a lot of value that can be opened up there over time. There's also quite a lot of synergies to the potential merger. Putting aside that Tyro's got excess capital that it was trying to work out what to do with, either acquisitions or return to shareholders. There's also SmartPay's payment processing. They at the moment pay a third party. Tyro could in-house that, as they have some of their own infrastructure on that. And there's a general people synergy that would occur if you brought these businesses together. So we think Tyro's tabled a fairly sensible bid. There is another bidder interested, but the synergies are potentially quite significant, and the combined business quite a large and in a scale business important entity if they're able to complete this. Just moving on to Big Tin Can, it's been a bit of a disappointment for years. We were happy to let that one go. We sold this into the market while the business was under takeover. You may have seen some of our attempts at the AGM last year. Needless to say, the operational performance had not improved by December, and it was a pretty poor result then. So we exited on market to a player who was happy to hold that to deal completion, but we got out with 94% of the proceeds and without the risk of the deal potentially falling over at the last hurdle.
It has actually gone through that Big Tin Can takeover offer, so people have got their cash, but the risk-reward trade-off there was still a sensible one from our perspective.
Just more generally as well, we've seen all these the market volatility of the last couple of weeks. It is opening up a lot of potential opportunities for us. There are plenty of businesses that we've been watching for 12 months, 6 months, going dramatically higher, thinking about those businesses being interesting at a particular price. We're now seeing a lot more of those come back to that price, and it just gives us the scope to introduce new businesses into a portfolio. Some of the existing portfolio, recycle those into new ideas alongside topping up existing positions as well. So we've already made one new investment during the last week, and we will talk to that one perhaps a little bit later on in subsequent monthlies and quarterlies. Back to you, Steve.
It's actually a really interesting market there. I mean, it's true globally as well, but the market's down 5 or 10 or whatever the number is from its peak, but there's a lot of stocks out there that are trading at 60 and 70% discounts to their 52-week highs. Some of those 52-week highs were stupid prices. Others are, businesses that have gone from very popular to very unpopular in a short period of time. So the pipeline on the new ideas fronts are very interesting there at the moment. Okay, I do want to leave some time for questions here, so I'll wrap this up pretty quickly. You might have seen an email. We're making a couple of small changes to the International Fund PDS, which is we're about to release a new product disclosure statement in the next month or so, and there will be a couple of small changes there. We're changing the benchmark for that fund from the MSCI World IMI Index to the MSCI World SMID Index. For long-term investors in this fund, it's not going to make the slightest bit of difference to you. You're fully aware that we mostly invest the portfolio at the small and mid-cap end of the market. But for new people coming to the Forager business and for new potential clients, it's going to give them a better reference point for how we invest the portfolio. And I think really importantly in this day and age of you can get your blue chip exposure through an index fund for very, very low fees. Our job is to sit alongside those, and I think this helps people understand that it is a small and mid-cap portfolio. We've also put in place a couple of constraints that give people confidence that it is going to remain a small and mid-cap portfolio into the future. Again, for existing investors, this would not have made any difference to the way we've invested the fund historically. You can see on a couple of these slides that I'm about to show, we have always invested the fund in line with these criteria, but we just wanted to put them into the PDS and on the website so that new people coming to the product understand exactly what it is. It's not going to be a portfolio full of global large caps. It's going to be a bunch of stocks that are different and out of the way and adding something to your portfolio that's different from those large cap indexes. So the caps are less than 20% of the portfolio will be invested in companies with a market cap greater than US 50 billion. That's something like 2/3 of the MSCI World IMI index is in companies that big, whereas this mid-cap index is a much lower market cap range. And the other one is just reducing the maximum cash holding from 30 to 20. Again, we haven't been above that 20% in the fund's history, but it is just giving people clarity here around how the portfolio will be managed into the future as well. This is the portfolio's large cap exposure since inception. You can see in the very early years there where we owned some Google and we were taking our time to deploy the cash. It was a touch above 20, but for almost all of the fund's history, it's been less than that 20% range, and we expect that to continue, or it will continue to be the case now into the future as well. And then this is the cash weighting in the portfolio. Again, early years took us some time to deploy the cash there, but for the time that this team has been in place, we've been mostly less than 10% in the portfolio. And I have said over and over again, we want to be mostly invested most of the time. And I think you've seen in recent months, there's plenty of interesting things for us to be doing, given the broad mandate that we've got. So when we get on the next quarterly update, you're going to see that the benchmark is that MSCI World SMID Index. We will keep showing you the MSCI World IMI. We're not trying to hide anything here, so it will be another line on that slide, and you'll be able to see how those two things go. It has obviously been a period of underperformance for small and mid-cap stocks. I think that will reverse itself over the next 5 or 10 years. The aim here is just to give investors a better reference point that is more applicable to the current portfolio and future portfolio as it will be invested as well. Okay, we'll move on to Q&A now. So punch your questions into the Q&A box on your screen, and I'll just take a moment to gather a few and we will get answering them. Couple of quick related questions here. Maybe Gareth, you can start. I mean, I feel like we've touched on this a bit in the presentation itself, but how does Forager position themselves with the uncertainty that Trump and his tariff war bring?
Question for the day, isn't it? You know, we try to price opportunities, not just get the magnitude right, if that makes sense. I think Steve and I shared a mentor early in our career that had a saying that really resonates with me, which is, if you're going to panic, panic early. We spent a lot of time discussing tariffs in February, early March, January. We trimmed some positions there of exposed businesses back before it really got into the price of things. So the one that comes to mind is Linamar. This is a Canadian maker of parts that go into new cars in the North American car system. They also sell agricultural and industrial equipment that often gets made in Canada and shipped across the border into the US. So this is almost the nightmare scenario for them, a big tariff in a market that for 40 years has been, you know, really quite free trade in terms of auto parts. We panicked early. We nearly halved our position in that stock, and it was the right move. Now, I think the world knows about it. The world realizes that this is not a blind threat. This is not it has some teeth. It's in the price. the time to panic has probably passed. And so we maintain that position. And I guess taking that question and then saying, applying it to how do we look at the opportunity set. So we've had a rotation really out of US into Europe over the past few months. People are trying to avoid some of the madness. We're still continuing to do that. We're still continuing to look for cheap quality European and UK and Asian investments. But also we're starting to really pick through some of the stuff that's been bombed out in the US that's been really, really hit by some of the madness. And it's just a matter of balancing that right and trying to make sure the portfolio is not too exposed to any one concept. Anything you would want to add to that, Steve?
No, I think that's a pretty good summary. And I think even in the Aussie fund, Alex, we're not immune to it here. And there's businesses in the portfolio where you've got to sit there and say, well, what would the impact of this be? We don't even know what this is. It's changing every day, so it's pretty hard to go and do an analysis, but it's worth going through the portfolio and saying which businesses are really affected here. And I think, again, back to the portfolio management piece that I've been talking a lot about it, I think it's really good to see, we're value investors. We find it hard to sell stocks that are down, but it's a real impact on a business like Linamar, and the right portfolio exposure for us to that stock is lower than it was 3 months ago, and these risks are a much lower probability. So, it's important just to be realistic about it and try and think about what the impact on your portfolio is. I'd say on the Aussie fund, Alex, it's relatively minor as we go across the portfolio.
I mean, I think that's right, Steve. We've had pretty detailed discussions with a lot of the management teams affected by this. I think one important part of it for Australia is that the tariff is as it currently stands, not particularly high. And also it applies often on the cost of goods sold if you are a seller of various things into the US. So that for some of the businesses that we own, they sell quite high gross margin products. And so the actual tariff is on a lower cost of that product into the US. But that is the first order impact of all of this. I think the more we're sliding into what is the second order impact here of just the uncertainty on, for example, travel to North America that we've seen fall off very dramatically. The Canadian numbers into North America have been a lot lower than they had been 3 or 6 months ago. And just the repercussions of the uncertainty with respect to more economically sensitive or more directly exposed industries is sort of a next step to all of this that we're sorting through as it happens in real time.
Well said.
Gareth, any quick comments on Wise? Jeff wants to know. They reported.
Not really. We love the business. We've outlined the case in a past quarterly. We bought it well. It's worked very well, very quickly. We were trimming coming into February and March a little bit. We really like this business. I've actually added back to it a bit since in the turmoil, the stock price has gotten cheaper again. Very good business, probably a category killer, and I like it. That's about it.
For both of you, have you looked at the defense sector?
I think I'll start on the Aussie side. By and large, on the Aussie side, the defense sector is reasonably low quality. We have and we do continue to look at things in that space, but there's nothing that immediately springs to mind.
We own a little bit through MTU Aero that not only makes commercial engines, aeronautical engines, but military ones for different programs in Europe. We have looked closer at a few things in Europe that, of course, now we wish we had bought, but no, unfortunately, they didn't make their way into the portfolio.
Yeah, I think if you're going to panic early. If you're going to get excited early is a good idea as well. And that Rheinmetall's been up 3 or 4 times over the past month. It's not the world's greatest business. Yes, it's going to have a better environment ahead of it, but I would say the market shift towards the defense sector has been significant and abrupt, and the easy money there has been made. We had a couple of stocks on our list that maybe could have, should have, of course, in hindsight, in the international portfolio in particular, but we don't have a lot of exposure there, and I think it's largely run its course. And I think in general, when you're invested in our fund, maybe healthcare's, you've heard about a healthcare stock on the Aussie side, a healthcare stock on the international side. That's a sector that's got some characteristics that people get very excited about at certain points in time. It's quite defensive. The money's going to get spent in a recession. There's a thematic there that is, I think, a good long-term thematic. It is the whole sector in recent years has been through some very difficult times because cost inflation has been high. It's caused a lot of troubles for hospitals. It's been a sector that investor enthusiasm has been very low in. So, we want to be trying to find these, if we're investing in a theme, we want to be trying to find it when it's unpopular, even if it has got some long-term legs about it. And defense is not that at the moment. It's got some long-term tailwinds behind it, but it's also very popular. Alex, Tyro, can you just give a quick update on potential effects of the RBA review there?
Yeah, I mean, as you can imagine, that has been a topic of discussion for Tyro, and we have continually tried to assess that. I think management has given some amount of, I guess, guardrails with respect to the very heart of what the RBA is trying to look at. For their business, that is a very small amount of their total turnover. And they actually stand to benefit, again, standalone from some other players, including SmartPay, but not exclusively SmartPay, using a different model, which is the surcharging model, that is sort of a flat surcharge across different card types. That is really at the core of these discussions, and specifically the surcharges on debit cards, which is really the bit that the government has come out against, and is the element here that would most likely hit SmartPay very hard. For Tyro, it is a very small part of the business, and the opportunity to take share away in that large, if there is upheaval as a result of that.
I think stepping back from that whole situation, I mean, Tyro has put an enormous amount of money into building what's a very important piece of infrastructure that allows people to pay with card and with their mobile phones. And I think they're not, it's not like they're over earning dramatically on what it costs to build that infrastructure. And I think whether it's the merchant paying for it or the client paying for it, or it's per transaction, or there's a whole bunch of different ways of working out how it's going to be paid for. But I think Tyro needs to get paid for the infrastructure that's got, and so do the other people who have that infrastructure. So I'm pretty confident there might be some volatility in earnings there along the way, but I'm pretty confident that business ends up earning a decent return on its infrastructure. We have a question about dividend policy and percentage. We will have an update out about that fairly soon, I would say, maybe before the end of May. The policy is not going to change, so our targeted minimum distributions will remain the same as they are at that 4% per annum. We are likely at the moment to have a special distribution on top of that in both portfolios, because there will be a meaningful amount of realized gains this year. So we'll have an update about that in the not too distant future. And it's going to be, given what's happened with markets, something that we're not going to be able to give you a lot of clarity about prior to year end, but you should expect probably something on top of the ordinary distribution this year in terms of a special. The hedging strategy for the international portfolio, you should think of the international fund as an unhedged portfolio. We do some tweaking around the edges to give it currency exposure that's roughly in line with the MSCI World IMI index. But if the Aussie dollar depreciates, you should expect that to help returns in the international fund, and vice versa. We don't see ourselves as experts in the FX forecasting space. We think that's a feature of the product, that it gives Australian investors unhedged exposure to international markets, and we're not planning on changing anything there. And then one last one that I'll answer. Ian's asked me what are some of the key takeouts from your recent investor meetings. I've been doing a few Zooms with some of our long-term clients over the past few months, and it's actually a good question, Ian. I think there's a lot of nervousness out there amongst the investor base. I think there's a reluctance to put more money to work in the current market, and I very, very often hear people saying to me, I know I can't forecast markets, but I'm very worried about where things are going to go. So that's the general theme out there amongst people. I think hopefully we've shown a bit today, but internally we've had a really stable team here now for a long period of time. We've put a lot of work into getting the strategy and the philosophy right, and we're really excited about this market environment as an opportunity for us to put all of that hard work into practice and deliver you some very healthy returns through difficult markets. And with all of the shift towards index funds over the past 10 years, which, by the way, I think is a very, very healthy thing for the average investor, keeping their fees low. I think this is much more the type of market where we can show some of the benefits of having a part of your portfolio invested with an active fund manager. And I'm really enjoying coming to work at the moment, and lots of exciting things for us to get out there and do. Okay, there's a couple more questions there that are stock specific that we might just get back to on email. If you haven't left your name there, we won't be able to do that. But if you have, we'll send you a quick email with an update about those stocks. But thank you very much for tuning in. Thanks for your support. And we'll be back in 3 months' time with our annual roadshow. Thanks, gents.